The Australian Financial Review.
Australians have long complained that buying a home is becoming less and less affordable.
Australia's housing crisis is getting worse.
It's a crisis years in the making.
More than 50% of Australians believe house prices need to come down.
But now that house prices are starting to fall after 3 interest rate hikes and property tax changes, the government has been reluctant to talk about it. And whatever you do, don't call it a correction.
The Housing Minister this morning said that house prices are correcting.
Well, I think the Housing Minister was using a general description rather than a technical definition.
Back from holiday this week, Prime Minister Anthony Albanese was asked for his view in question time.
Scott Pape, the barefoot investor, wrote, "Somewhere along the way we started treating houses like a share price. We forgot what they're actually for. A house is for living in."
The government has really been tying itself in knots over this. It doesn't know whether to own the affordability benefits of falling house prices or to really just shy away from even discussing the declining value of what for many people is their biggest asset.
Welcome to The Fin. I'm Lisa Murray. This week, Deputy Economics Editor Michael Reid on what's going on in the housing market, whether it's the correction we had to have, and why politicians don't want to call it that. It's Thursday, August 13. Hi Mike, thanks for coming back on the podcast.
Thanks for having me back, Lisa.
Mike, every week we're hearing about the downturn in the housing market. Prices are falling, buyers are dropping out of auctions, clearance rates are down. We're breaking it down by postcode, by electorate. Everyone's watching these prices fall. Put this in perspective for us. How does this downturn compare with others in the past?
Yeah, so last week we found out that national average home prices fell 0.7% in July. And that might not sound like a lot, but it was the biggest monthly decline since December 2022 during the last housing downturn.
Mm-hmm.
That particular correction was triggered by the RBA's quite abrupt exit from its pandemic-era zero interest rate policy, and capital city house prices ultimately fell by 8.1% over a 9-month period. We're still in the early stages of the current downturn, but the first thing to note is that so far, the largest price declines have been in Sydney and Melbourne. And then within those cities, the weakness has primarily been at the top end of the market. So in Sydney, for example, prices in the most expensive quarter of properties, they've fallen by 5.2% just over the past 3 months, compared with a 1.4% fall for the cheapest quarter of property.
Okay.
And that gap, that's partly because the price of those really expensive properties, they'd risen by much more in the first place.
Mm-hmm.
And partly because the lower end of the market is benefiting from the dramatic expansion of the federal government's 5% home deposit scheme. That scheme allows first home buyers to get in the market with a deposit of 5% and avoid paying lenders' mortgage insurance. So then on your question of how the current downturn compares with previous ones, AMP ran the numbers for us. So far, 4 months into the current downturn, capital city house prices have fallen 2.8%, which is sort of broadly in line with the correction we saw from 2010 to 2012, but less severe than at the same stage of the 1989 to 1991 downturn and that previous slump I mentioned in 2022 and 2023.
Mm-hmm.
So in many ways, this is still a fairly garden variety housing downturn. What we know about downturns is that UBS economists estimate the average house price correction since the early 1990s has lasted about 13 months, with an average peak to trough decline of around 5%. Although it is a bit fraught comparing downturns because they all have their own unique stories.
Yeah, that's right. There's different things that trigger them.
Yeah, so the 2022-23 downturn that I mentioned, that followed the withdrawal of once-in-a-generation pandemic support.
Mm-hmm.
The downturn before that, from 2017 to 2019, that had its genesis in some quite tight new investor lending rules that were quite suddenly imposed by APRA, the prudential regulator. So there really is a range of possible outcomes this time. Some forecasts suggest falls in Sydney and Melbourne could be close to 10%. But even then, that would still be within the range of recent housing downturns.
It would still be a garden variety housing downturn.
Still garden variety, as far as all the economists think. What does make this one unusual, though, is that the downturn may have started with higher interest rates, but it's now being amplified by some quite significant changes to federal government tax policy. In the May budget, we saw the government announce changes to negative gearing and the capital gains tax discount aimed at reducing the tax advantages of property investment and making it easier for younger first home buyers to compete with investors. And then this week we saw new laws come into force banning people who have self-managed super funds from borrowing money to invest in the property market, which should also put downward pressure on prices.
But then isn't what's happening a reflection that those policies are working? We've been complaining for years that housing is unaffordable in this country. Young people can't get into the market. Now that house prices are falling, why doesn't anyone, particularly government ministers, want to talk about it?
Yeah, the government really has been tying itself in knots over this. On the one hand, the policy changes in the budget do appear to be having the desired effect of putting downward pressure on prices. But on the other hand, no government wants to be associated with the falling value of people's biggest asset.
We see periods of very significant house price growth and then we see the market make a correction, and that's what we're seeing at the moment.
We saw that dilemma when Housing Minister Claire O'Neil acknowledged in June that we were seeing a correction in the housing market.
So we're in a market correction now?
That's correct. I don't think that's controversial at all.
We then saw Treasurer Jim Chalmers quickly distance the government from the slump.
Well, I think the Housing Minister was using a general description rather than a technical definition.
Arguing that the decline reflected reasons that went beyond changes in the budget,
including changes in interest rates, softness in the broader global and domestic economies.
And insisted the market hadn't met the technical definition of a correction. We've then seen Deputy Prime Minister Richard Marles try to chart some sort of middle ground.
There's no doubt that we are going to see an increase in housing prices, but we'll just see a sustainable increase.
Which I think essentially means prices continuing to rise, but slowly enough to improve affordability for younger buyers rather than outright price falls that risk angering people who own their own home. Rather than talking about prices, we've also seen Labor MPs start to invoke, some rather pleasant-sounding anecdotes about how first home buyers are finally feeling empowered. Backbench MP Josh Burns last week said,
more and more first home buyers are having conversations around the dinner table saying, you know what, it's actually possible.
About finally being able to get into the market.
And the conversation has turned from, it's going to be impossible for me to ever own my own home, to now, actually, it might be possible.
While Environment Minister Tanya Plibersek has even gone as far to say,
there's never been a better time to be a first home buyer. Not in my lifetime has there been a better time to be a first home buyer in Australia.
But really, perhaps one of the reasons the government is avoiding talking too directly about falling prices is that some of its MPs don't even really seem to fully understand what's happening themselves. We saw Assistant Minister for Foreign Affairs Matt Thistlethwaite get into trouble last week.
99% of people have met their repayments or are ahead on their mortgages.
Over negative equity.
It means they can't be in negative equity because they're ahead on their mortgage repayments.
No, that's not true.
The scheme is working very well.
Where he appeared to confuse the idea of borrowers being able to repay their loan on time with whether their home was worth less than their mortgage. On the whole, the political problem is pretty simple. Labor wants to claim credit for making housing more affordable without being blamed for making people's houses worth less. One of the challenges it has here is the group that benefits from falling prices is actually quite small. It's mainly really prospective first home buyers with substantial cash savings who are ready to buy at the moment. For everyone else, cheaper housing doesn't necessarily help much if you still don't really have that deposit in the first place, or if you just don't earn enough to service a mortgage. And if you do already own your own home, as I said before, falling prices mean the value of your biggest asset is going backwards. So if you put that all together, the constituency cheering on lower house prices is quite small compared to the constituency who are worried about falling prices.
And it's interesting, this debate about what to call what's happening. You saw that with Chalmers and O'Neill tying themselves in knots over what is a correction. What is the definition of a correction in the housing market?
Just to make things more confusing, there really isn't a universally accepted technical definition of a housing market correction. It really is just more of a vibe. You know, in equity markets, when we speak of a correction, we're talking about a 10% fall in prices. But in the housing market, there is no equivalent hard threshold. So when Jim Chalmers said the market didn't meet the technical definition of a correction, that was a bit misleading because there really isn't one to speak of. But overall, given prices are now falling nationally and the declines do appear to be broadening across capital cities, I think you can comfortably call it a downturn or a correction or whatever floats your boat, really.
So whatever it's called, what are economists and analysts predicting about this downturn? How will it work its way through the economy?
There's a whole range of forecasts at the moment, Lisa. NAB expects Sydney and Melbourne prices to fall around 10% peak to trough, while the mid-sized capitals might experience falls of around 2 to 4%. AMP expects national home prices to fall around 7%. Judo Bank expects them to decline by 7.5%. So there's a real range. In terms of the broader effect on the economy, we're already seeing a decline in housing turnover and auction clearance rates. You've got sellers who don't really want to put their home on the market while prices are falling. And then you've got buyers who don't really want to catch a falling knife and are happy to wait a little bit for further price falls. Economists and the Reserve Bank expect the housing downturn will weigh on consumer spending through a couple of different channels. The first one that people are probably familiar with at this point is known as the wealth effect. Basically, people's homes are their biggest asset. So when its value falls, people tend to feel a bit poorer and can become more cautious about spending. The second channel is through housing-related spending. If people are buying and selling fewer homes, then you just generally see less spending on furniture, appliances, homewares, kind of all the stuff that you tend to buy to furnish a home when you move or you're getting ready to sell. On the investment side, we also know that falling prices can make property developers a little bit more reluctant to start new housing projects, so they may put developments on hold. That in turn means less residential construction, which is potentially another drag on growth. Although saying that this time round, that particular channel may be a little bit less of a problem. We know that the construction workforce is already operating quite close to capacity. There's a big pipeline of investment in areas like data centres, and it's quite plausible that that could absorb some of the workers and resources that are released by a weaker housing market. Saying that overall, we should expect falling prices to weigh on household consumption, housing investment, and in the process, put downward pressure on inflation. I guess I would note that we did enter this downturn in a pretty solid position. The unemployment rate is still a very low 4.4%. So most people with home loans are still in work and they're still able to keep on making their repayments. There may also be another big, somewhat unexpected positive from falling prices, at least from the perspective of homeowners with a mortgage. A weaker housing market will take some of the heat out of the economy, and that in turn should take pressure off the RBA to raise interest rates again. We saw that this week with the RBA leaving the cash rate on hold, giving borrowers a very welcome reprieve.
We're talking about the downturn in the housing market, which was triggered by higher interest rates and changes to the way the government taxes property investment. One of the impacts of a depressed housing market is to take the pressure off, in the short term anyway, on the central bank to raise rates further. And we saw that this week with the RBA keeping rates on hold. Mike, you were there asking some questions?
Not only was I there asking questions, I was in the front row, no less.
Oh, very good.
Thanks, Governor. Michael Reid from the Australian Financial Review. How are you and the board thinking about what the downturn in the housing market means for interest rates? Does it make a rate cut in the medium term more likely?
Thanks, Mike. Before I answer that, can I just...
And yeah, it wasn't just me asking about the property market. There was a lot of other journalists in the room who had similar questions, and you could tell that Michele Bullock was quite prepared to face a grilling on that particular topic. She said, essentially, the housing market
isn't really the main game here for us at the moment.
She's still quite preoccupied about the upside risks to inflation. She nominated quite a few of them. She's worried that the jobs market is still too tight,
particularly in some areas like construction.
She's worried that the data centre boom is adding to cost pressures in the construction industry. She's worried about the lack of resolution to the conflict in the Middle East and what that could mean for higher costs passing through the supply chain.
These are all the things that are front of mind in terms of risks to the inflation outlook.
And it's for all those reasons that she said risks are still to the upside with inflation, and she may need to raise interest rates again potentially later this year. On the housing market, the RBA has been asked about this for years, and it's been at pains to say that fundamentally the issue with the housing market over time is that we're not building enough homes, that there is an inadequate supply pipeline, and there's no sense in which that problem is going to be addressed anytime soon. And that's fundamentally a matter for the federal and state governments to work together to resolve. It's nothing that the Reserve Bank can do.
So what are the political implications of all of this? On the one hand, first home buyers are better off with falling prices, but is the government vulnerable the longer this goes on and homeowners across the country feel that little bit poorer?
Look, voters are unlikely to directly punish the government simply because house prices are falling. And if history's any guide, the current slump will almost certainly be over by the next federal election in 2028. But a prolonged housing downturn could absolutely contribute to the broader sense of economic pessimism that is already fueling support for one nation. There's one obvious group that benefits, as I mentioned earlier, and that's prospective first home buyers who are ready to enter the market. But that is a relatively narrow group. On the flip side, we've got a large cohort of renters who are dealing with sharply rising rents and a really tight rental market. And then we've got existing homeowners whose biggest asset is falling in value. So the political benefits of cheaper housing are not evenly distributed at all. If prices do continue to fall, the Coalition has already made a tack line that the Albanese government has essentially encouraged people to buy at the top of the market, and that could have left some of them vulnerable to falling into negative equity. And that's because last October, Labor dramatically expanded its 5% home deposit scheme. And since then, we've seen more than 28,000 first home buyers enter the market through the program. And so if prices fall substantially and the downturn persists, some of those buyers could absolutely end up in negative equity where their mortgage is worth more than the value of their home. At the moment, the problem is still fairly contained. Michele Bullock said this month,
negative equity remains very limited, affecting less than 1% of borrowers.
But it is reasonable to expect that figure will rise over coming months as prices fall. But there is a political trap too here for the Coalition. If it attacks falling house prices too aggressively, it does risk looking like it's defending high house prices and the wealth of existing homeowners, precisely when younger prospective buyers may be cheering on a correction. So neither side has an entirely comfortable political position here.
Mike, last time we had you on the podcast over a year ago, we were actually talking about whether the housing market was about to take off again. It was a very different economic situation. The central bank had just cut interest rates. And you were nervous because you were looking to buy a house and you didn't want prices to increase greatly suddenly. Did you end up buying?
I did. It was definitely a very different situation then. The housing market was starting to take off again. Interest rates had just been cut. And I was actually quite nervous at the time about prices running away from me. After far too many inspections, I eventually managed to snag a cute little townhouse in Canberra's inner north.
Congratulations.
Thank you very much. It's attached to a not that cute, rather large mortgage. I've deliberately avoided checking what it's worth since I bought it, but given what's happening in the market, I have a feeling it's probably worth a little less than what I paid for it, or it will be soon at least.
And so a final question then, how are you feeling right now as the Financial Review's Deputy Economics Editor and as a homeowner about what's happening?
Well, firstly, I think probably a little bit of perspective is needed in the debate. National house prices have fallen just 2% from their peak. They're still about 70% higher than they were a decade ago. Housing remains deeply unaffordable for many Australians. And it's worth remembering just how difficult it has become to get into the market. It now takes the average family about 11 years to save a 20% deposit, up from 8 years in 2005. At the same time, the housing boom has made some Australians extraordinarily wealthy. And so there are really different experiences depending on whether you already own a home or you're trying to buy one. On the possibility of negative equity, which seems to have emerged quite a bit in the debate, I think that can just sound a bit scarier than it actually is. If you still have a job and you can service your mortgage, the fact that your house is temporarily worth less than your loan does suck, but you don't have to realise that loss. Negative equity really only becomes a serious economic problem if it becomes widespread and it's combined with a severe downturn. That's when you can see people unable to service their mortgages. That's when defaults may start to increase and that starts to flow through the banking system. But there's really little evidence that we're facing that kind of scenario. In fact, the RBA's assessment is that most borrowers are in a pretty strong position to weather a downturn. The vast majority have enough income to cover their mortgage and essential expenses. Arrears are low. Borrowers have built up substantial savings and equity buffers. And actually, the RBA estimates that even under a severe 40% fall in house price scenario, about 80% of borrowers would still have positive equity. So this isn't a situation where a modest correction in housing prices automatically translates into a financial crisis. Ultimately, also, I think we need to remember that housing is a market and markets do go down as well as up. We've become quite accustomed to house prices rising almost relentlessly, but downturns are a normal part of any asset market, and we do need to be able to live with them. And really, if history is any guide, a downturn will eventually be followed by another upswing. That doesn't mean prices should always rise or that falling prices are necessarily bad, but it does mean we shouldn't treat every fall in house prices as a crisis.
Thanks for coming on the podcast, Mike.
Thanks for having me, Lisa.
Thanks for listening to The Fin. If you want to read more about the housing market downturn, check out the show notes. And don't forget, you can listen to all Financial Review podcasts on the AFR app. The Fin is produced by Mandy Coulin. Fiona Buffini is Head of Premium Content. Our theme is by Alex Gow. For more stories about markets, business and power, subscribe to the Financial Review at afr.com/subscribe. I'm Lisa Murray. See you next week.
The Australian Financial Review.